Ladies and gentlemen, it's Adrian Zunchuk, CMT Charter Market Technician. Welcome to the sixth edition of our Trading Congress. And I'm here with so many incredible people here, where we are actually just putting together one of the nicest events throughout the entire year. We called it Free Trading Congress over the years, right? As a reality, I think, uh, what's free about this part is that the free is the experience part, right? Each and every single person can actually experience what becoming a good trader means, what becoming a good trader in just a couple of days means, what what it means, what it feels like actually, just to get a sense of how it feels to stop missing out all those pumps, all those incredible gains, all those massive rallies that not only have been happening for quite a while, but also they're supposed to extend and continue for the next several months to come. And I think it's a great honor to be hosting those editions, the sixth edition of our Trading Congress, aggregating thousands and thousands, tens of thousands of users every year. And we've been doing that for purpose, for a good reason. We at the Birb Nest, we believe in a financial world where freedom is accessible for everybody, everywhere, regardless where they are from, regardless what they do, regardless who they are, so that each and every single person on the world deserves a chance and access to financial information, to financial education, to knowledge, to assets, to software, to tools, to entire toolkit that is basically uh, making them have an option to just make educated choices, the better choices, the better trading decisions. And as a matter of fact, that's been the main mission behind everything that we've been doing within the Birb Nest ever since 2017, right? We've been saving crypto bros for the past 7 years and counting. We're gonna soon start the kickoff in the 8th year. We're gonna celebrate our huge anniversary, 27th of December. I remember time flies so fast; it feels like it was just yesterday. And the entirety of the equipment that we give out to the people, the entirety of the education, of the skill set, of the assets, of the software, like I said, of all the indicators, of all the toolkits, and the sense of community with 24/7, 365 basically support engagement from me, from my team on the guidance side, right? To try and help basically avoid falling victim of all those rugs and rug pulls and all those scams, right? Where so many influencers, where so many scammers there actually get recognition, right? Without much reason, mainly because they are very aggressive about what they do, what they speak, how they speak, and that at times just I think just attracts a lot of noise around them, and a lot of people, hundreds of thousands of people, millions of people, actually fall victim of all sorts of scams. So as a CMT, as a charter market technician, my job is to propel and help everybody just understand more of the market techniques, what it means to be a trader, what it means to be a full-time trader, what it means to be an intraday trader, position trader, a buy and hold strategy, kind of like an approach. And each and every single one of those aspects basically results in many different outcomes, right? The buy and hold might be good for someone who wouldn't have much time to trade. However, holding for the bear market means getting exposed to 80-90% drawdowns that not many people can really I'd say appreciate, right? Of course, if they're on the wrong side of the trend of the fence. So all in all, the fact that you're here watching that and viewing and listening from all around the world within the sixth edition of our Trading Congress, the Trading Congress 2024, within this grand opening that I want to welcome everybody warmly, this is significant. This is meaningful, and I welcome everybody very warmly. And I'm going to be your host. I'm going to be your guide throughout this session and a couple of other sessions throughout the week, alongside my incredible team at the Birb Nest and our major, like incredibly talented and gifted speakers, right? So think of it as a virtual trade camp, as a virtual summit for traders to come learn on how to become better trader. Like I said, more efficient on the winning side, less risk on the losing side, so that the actual outcome in just a short period of time is actually a lot of takeaways, a lot of to-dos, a lot of don'ts, right? A lot of do's, a lot of don'ts, and the actual, like I said, access to all the VIP education. Each and every single open a corner of the Birb Nest is right now open for the entire world. It's free, it's accessible, there's no charge. Everybody can enjoy and take away as much knowledge as they wish. And with that, I want to hugely appreciate and acknowledge our incredible sponsors and partners actually here for this particular event, for this particular Trading Congress 2024. I'm talking about DYDX, I'm talking about Cointel, I'm talking about Bybit, and I'm talking about Dragon's Lair, our incredible partners who are here basically, like I said, committing to making the space better, cleaner, more reliable, trustworthy throughout spreading this education and the financial knowledge. So we are right now, it's actually 25th of November. 25th of November, meaning that there's 5 days left till we start December. So we always, as traders, it's fair to have certain anticipations. It's fair to have certain assumptions, some baselines, some expectations, right? At the same time, our job over the years, so many mistakes that I made back in the day, like in the past, all of them contributed to my wrong understanding, to my flawed understanding of how the markets work, that I have to be able to predict the markets basically to in order to make money off of it. While in reality, that's not necessarily the true and the case, right? So all in all, we're going to have a proper discussion about what's ahead potentially for December, not based on my guesses. I mean, I may give you my guesses, right? But I may be wrong. I'm going to give you the numbers. I'm going to give you the facts. I'm going to give you the facts, the numbers, the raw evidence, raw numbers, something that cannot be refuted, something that cannot be denied. Because as a matter of fact, if we deal with the decision making in the financial space, we have to make educated choices. Making educated choices and informed decisions means relying on the data and the past experience, because that's the only thing that we have, right? And if we have enough of data, of a large sample of data, we can basically make those choices fairly accurately, right? So if I were to kick off right now, you're seeing the screen on the DevBlock website, right? We're Bitcoin ETFs, which as a matter of fact is a very crucial highlight of 2024, right? Because we are narrowing, like I said, we're getting closer to the last month of the year, to the last 35 days actually of the year. The year is almost complete. And one of the key highlights has been definitely introduction of this institutional capital to the industry like never before. We're talking about the numbers over $500 billion of cumulative spot volume so far, and it's actually counting. And if we just take a deeper look, like I said, 542, right, per couple of days ago, but 3 days ago, it's actually 542 billion, right? 542 billion, and even over that, of cumulative spot volume. This is the volume on the spot ETF Bitcoin side that just the institutions brought. It's $500 billion, more than $500 billion of dollars, basically, of the generated volume that was brought to Bitcoin. It's coming from the institutions. They're playing wild card. They are going very crazy and very aggressively about the Bitcoin demand. There are institutions in the space. Larry Fink talks about crypto and Bitcoin as flight to quality. There's Kathy Woods that just prices in bullish cases, multi-million-dollar Bitcoin targets, Ethereum to reach $20,000 by or more. So all of those positive stimuli that happen to be in a space from the institutional side, arguably are exactly what's going to materialize in one way or another. Whether Bitcoin is going to hit 100,000, well, it's already done, right? Whether it's going to hit 150,000, 200,000, no one knows the future, right? All that I know from my own experience is Bitcoin and crypto is unpredictable and chaotic enough to prove our wildest expectations wrong. Bitcoin goes way lower than anybody expects in the bear markets and way higher than anybody expects in the bull markets, right? So all in all, what I'd say is that if we go ahead and track the actual numbers, right, for everybody, then it gives us the perspective on potentially what's ahead. Last year, Bitcoin performed with 160% year, the entirety of the year, kind of like a return. This time, I'm just looking right now as we speak at the data from MarketWatch. It's year to date of over 130% since the opening of the year, and it's yet another extension of 2023 as a pre-election year, right? So we are looking at very strong candidates, very strong markets. And the markets seem to move in a fairly reliable fashion of 4-year cycles. There is the coincidence of the 4-year stock market presidential cycle, as well as the halving cycle from Bitcoin side, and they all coincide at this time. So all in all, if I'm gonna show you like the next reviews, here's where we're gonna find. Let's take a look at this one, right? So exactly what we're looking here is um, is the Bitcoin $2, on a long-term basis, on a Bitcoin $2 that is basically right now tagging. Like I said, it's just tagged $100,000 mark on the future side with the CME. It almost got there on the spot side, right? Which obviously, like I said, there's a lot of reasons for us to anticipate, like I spoke on a previous shows and the previous streams, that um, $100,000 is this magical number, round number, because we tend to allocate our special attention and focus to numbers that are easy to commemorate, that are easy to remember, that are easy to associate, right, with. So I'm talking 100,000, 10,000, 1,000, 3, 5, all those round numbers, right? It's so much easier to appreciate right now the $100,000 instead of 111 32.7.57, for instance, right? They are so much more difficult to remember. So that we operate with those round numbers, and because of the um, of those round numbers proximity, our focus and our attention gravitates towards those round numbers. And because it happens this way, we actually materialize those and we place our buy and sell orders around those round numbers. And if that is the case, then actually this is where support and resistance are built, right? And if that is the case, again, this is where the markets have this initial opposing force. Whenever we get there, there's going to be a consumption of all those buy orders by the previously set preset limit sell orders, right? Those asks of people that just take profit not because it's I should say rational, right? But it's because made out of fear, because we fear of the unknown, we fear of the uncertain, and we fear of those raw numbers, because like I said, our thought priming materializes them to work. We make it work, we make technical analysis work, we make technical levels to work as support and resistance, right? They don't happen magically, and even if they do, that doesn't matter, right? There's a lot of randomness and chaos in the world. So all in all, having those recap of 2024 trends, well, what we are looking is, like I said, ever since 2024 started, we are looking basically at 130 over 130% year-to-date return on Bitcoin side, right? And if that is the case, we're looking at a mostly strong correlation. However, it's been fairly choppy, right? But most of the time, if you take a look here, most of the time we are actually staying on the positive side of the correlation coefficient, right? On the bottom clip, there is a correlation coefficient of Bitcoin against S&P 500 that basically tells you that, by definition, well, is the ratio of covariance of how Bitcoin and S&P 500 statistically covary, how they move together in the same direction against the product of standard deviations of each, right? So if we have this kind of like an understanding of how often Bitcoin and S&P travel together against all of the possible ways, probabilistically, then we arrive at a conclusion that, well, put it simple, 69% so far, approximately, of the movements are coinciding, right, with Bitcoin and S&P 500, meaning that Bitcoin is quite strongly correlated, 69%, towards the S&P 500, and there is strong connection. One impacts another, whether it's causation and correlation. There's always this debate, which causes which to move, right? Although from the trading perspective, it's irrelevant. It doesn't matter. It's just not important, because the fact is that this number is strong, and if it's strong, and if the S&P 500 rallies, then statistically there's 69% of the chance right now, to put it simple, in a rule of thumb type of a manner, that 69 out of 100 times we're going to see Bitcoin move in the same direction that S&P, except for July, for the corrective period, right? Because if you take a look at those corrective periods, basically, take a look at the peak that happened on the correlation over 93 points, right? Point of 93. So imagine it's 93% of the time that S&P and Bitcoin move in the same directions. And we actually, ever since the correction started, we saw the massive decorrelation, or I should say, inverse correlation from there on, right? Passing through the zero, and there is zero correlation equals zero, meaning that the covariance is zero. There is not a single time that Bitcoin and S&P move in the same direction. They are completely random. There's no formula for it, right? However, if they go and fall to the very negative extremes, as in minus 90, like I highlighted so many times throughout the Q3, which is typically a weaker period in the year from the season, then this is where the market bottoms. And guess what? This is what soon after brought us the market bottom at $49,000 or $50,000, if you will, with the Japanese, the Bank of Japan there, kind of like being on the verge of collapse, and the Nikkei 225 basically collapsing, wildest crashes since 1970s or 80s, if I'm not mistaken. So all in all things concerned, what matters is that the trends are moving upwards, and if the trends are moving upwards, that means that holding on to Bitcoin over time brings more money. And if that is the case, means that everybody who stays with Bitcoin ever since it started rising basically on a 50-week basis since May 2023, right? This is where it inverted on a weekly scale. Then basically everybody made money. And from 22K towards 62K, so almost 3x, right? Almost 200% pure profit, almost 3x over what it was before, all right? Within the scope of a year and a half. So 3x in a year and a half on average for anybody who's holding Bitcoin since 2023 May. It's not a bad result at the end, at the end of the day, like I say. And if we are to take it towards the feather clip, right, here we are. If we are to take it towards the feather clip, what we're looking at is the weekly chart of Bitcoin, except that this one is a 200-day moving average. This 200-day moving average basically is as a negative dominant trend of the market to move in one direction or another. And if it's a bear market, well, we recognize that it's a bear market by the direction and the slope and the continuity of the movement of the S&P of the 200-day moving average, right? So if the 200-day moving average continues to move and slope downwards, then this is a pure definition of a bear market, right? It's not enough to just give us a small tick, right? However, it only, because of the lag, it only kind of like comes after significant breakdowns, right? So that after a massive slide, massive reversal, there's some actual confirmation from the market that the break actually happened, that a breakout happened, right? So the continuous, consistent decline in the SMA 200 is basically what we define under the term of a bear market, right? And I keep reminding to everybody that the bear market is not a term on the economic side. It's a term on the financial side. Economy and finances are two different things. It's the financial market that actually empowers the economic cycle and not the other way around, right? And to give you just a little bit of a proof, let me show you the performance charts. All right. This is exactly what I mean. This is stockcharts.com, sector rotation model. But think of it like you see the orange curve and the blue curve, right? The orange curve is exactly the financial stuff. So the bottom orange clip applies. And the bottom clip is basically market bottom, bull market, market top, bear market. All right. So this is the financial market cycle. This is the finance. This is the financial markets. This is Bitcoin, crypto, S&P, commodities, stocks, derivatives, and so on and so forth, and the forex currencies, of course. Right? While the blue curve, the upper clip, is the full recession, early recovery, full recovery, early recession, recovery or expansion. So this is economic side. And what you see is that the financial market tops before the economy tops, as the financial market reverses to the upside before the economy reverses. Right? So there is this significant 6 to 9 months lag between the preceding financial cycle and the economic cycle outturn, right? An outcome. So it's the financial markets that actually just empower the economies to grow. If people make money on the markets, in the markets, by staying in, for instance, with Bitcoin, they have earnings, they have kind of like perhaps income, passive income. They are profitable. If they are profitable, they have money to spend. And if they spend on goods and services, basically empowering the economy in turn, right? On the opposite case, if the bear market comes up, well, in reality, right, people become more conservative because they keep losing money on average. So they are feeling more and more conservative, defensive, just unhappy, miserable. And the sentiment on the consumer side just prevents them from spending. And if that is the case, well, the economy falls victim of that, right? And the economy stalls or falls into recession. So that is the simplest way to kind of like understand it. And right now, what is irrefutable, right? What is undeniable, what cannot be refuted, what cannot be denied, is basically that we're looking at this consistent incline of 200-day moving average. This meaning that the bull market goes on. And guess what? It's not only me saying that. It's actually not only the fact and evidence. It's also the technical insights that are there, right? The massive push of Bitcoin from the Trump's election of basically 68,700 or so, or even bottoming out a little bit earlier, sub 60,000, all the way to $100,000, right? What a significant push, over 40% massive push in just 3 weekly bars or candles. So 3 weeks it's taken, not even that, 3 weeks it's taken Bitcoin to actually just push over 40%, right? And before that, it must have taken so many weeks, 260 days, if I'm not mistaken, right? So two-thirds out of the entire year, two or even more, to correct and to consolidate and just move sideways, or actually here slide downward slope, right? So corrective tide took 230 days, and just to recover and push through and move higher towards the new all-time highs daily, we actually um, we actually took it only 3 weeks, and the entire market got a massive influx of that, right? And if we take a look literally right now at the total market capitalization size, then what I'm looking at on my phone right now is 1.927 trillion on Bitcoin alone, right? The total market crypto cap is basically over $3 trillion. And that's a significant growth. That's a significant growth. The altcoin market cap, I think, just grew, or actually the total market cap grew over the last 30 days by over 40%, right? That's a significant boost, significant growth. So as long as the 200-day moving average continues to rise, and keeps making higher highs, high lows, this is indicative of the bull market continuation. And guess what? We keep breaking those new highs. Those 100K for all those other reasons seems to be, the next target. All right, we should be back. And if we are back, well, this basically means the Bitcoin might be back as well, right? So I appreciate your patience. And moving further along, let's take a look at the actual seasonality expectations for December, right? I'm using for that particular purpose the SeasonX service, right? The SeasonX, like I said, we are actually not partner up, so we're like this is not affiliated. Although this is what I do, this is what I use on a daily basis, basically for all the streams for the personal use. And when I take a look at the numbers, basically, how it works is I set up the time frame basically ever since the very origins of Bitcoin. That is the July 23, the first listing time basically for Bitcoin, and I take it, drag it towards the November 2024, 23rd, right? So just a couple of days ago. And then when I apply it, I actually use the trending model because, of course, the strong trends of Bitcoin just make it go up all the time. So it makes sense to detrend all the data right there using this very button. And basically what it tells me this, takes off this trending effect to give me pure seasonality change for the month, and it's just easier to read and better to read. It's taking away those trending factor. All right. So if I take a look at what time frame I want to check, right? So it's, for instance, the entirety of December taken out of the 14 years. What it tells me is, well, first of all, the annualized return on the right-hand side is 174.22%, right? If we compare it, for instance, with November through December, it's 446%. So it's so much stronger, right, than December. So December is 174. So 160 or so, 140, 150, 160 against 174. So it's more than twice weaker. So it means that with the 57% of the time or more being winning trades, right? So the 57% of the time December is positive. So it's much more of a roll of dice than, for instance, November, right? November is 64% positive. December is right here, 57% positive. Average return is 8.64%, right? So 8.64% taken out of the 14 years with 8 gains against 6 losses. It basically tells me about my expectations, what I can expect, from the market in December. And all I know, the market is positive, right? Because otherwise, if I take a look at August, for instance, through September, then most of the time it's negative, right? Minus 58% annualized gain, 6%, almost 7% average return to the downside, right? And here we are. So it sets the positive expectations basically for December, right? There is this Santa Claus rally effect, as we know it. Santa Claus rally effect is basically destined for a lot of kind of like a present buying and gifting, right? When everybody's celebrating Christmas, there's like more relaxation, more time off, I should say, family kind of like gifting. And well, guess what? If you buy a lot of presents, this gives earnings to the company that just issued those presents, right? This empowers the economy. This kind of like just brings the earnings additional to the companies. And if the companies have a lot of earnings, their fundamental valuation goes up, right? So this is also why a lot of stock markets tend to rally. This is the effect that we know as a Santa Claus rally, right? Towards the later part of December, that lasts until the end of the year, which is why you often see the final kind of like last couple of days of the year basically rallying into the year close. Even if we take, like I said, the second half, take it 15th through 30th, right? 31st. So 75%. So 75%. So almost even more than half of our returns is actually generated throughout the last 2 weeks of December because of the Santa Claus rally, and it's positive most of the times, right? Right there. So the entirety of December is positive, and all I know that imagine we close the session. All right. Imagine we close the month. There you go. I'm gonna take it to the monthly chart. All right. Imagine you close the month just like it is right now. Let's actually get rid of this. We close the month just like it is right now. Just closes flat from here, right? Consolidates, moves along. So if we take let me look it up again. What was it? it's 864%, right? So if you take 864%, we add it to the current price, 864%. Let me just actually fix it so that it's visible. Style, background, label, we want it black, right? So we want 864%. Takes us basically over $100,000 towards, well, somewhere close to $106,000. So simple maths basically can be of a little bit of guidance that if the month is positive, you're going to add on top of the closing price. If the month is negative, you're going to add, actually deduct it from the closing price, right? So you can use those simple methods via the seasonality checks on the markets, basically to know, what to expect in a month ahead. And it's not necessarily guarantee of that the future is basically behaving exactly the same way like the past does, right? Still, it might become helpful in setting the expectations to know, okay, I'm going left or right, I'm going up or I'm going down on average. So it's indicative. And because it's indicative and because we read the data, people at times amplify this effect and make it a self-fulfilling prophecy, right? And if they make a self-fulfilling prophecy, this works and it actually amplifies and it works the way intended. So overall, I'd say that all the other assets, like take a look at Ethereum, all right? I'm gonna take the same look at Ethereum. Ethereum right now, when you compare it with Bitcoin, it's so much further away. It's so much weaker. It's so much more different, right, than Bitcoin. Because like simple check, let's say give it a coin market cap. I'm just gonna flash it here. There you go, right? If we compare it with Ethereum, right, what we're looking at, and we want to like even the last 30 days. The last 30 days, difference between Bitcoin and Ethereum is basically 5 percentage points or so, right? So Ethereum has caught up in terms of the last month, right? On a 7-day basis, it's actually outperforming Bitcoin, right? Because it's becoming stable relatively against Bitcoin that is moving to the downside. On a daily basis, Ethereum outperforms, with today's move up, basically Bitcoin, and there is a decent performance difference of 4.5 points, almost 4.5%. Although on a yearly basis, the difference is even more significant in favor of Bitcoin, right? Because Bitcoin what it does is it gives you 161% of a year basis, not a year today, but 1 year from now, so 25th of November last year, all right, versus 68%, 60 almost 9% on Ethereum. That gives you a range of almost 100 basis points difference, 100 percentage points difference, right? So it gives you so much more value, so much more money, basically, if you stuck with Bitcoin. So those relative performance, this momentum type of investing, momentum present in the market, this invisible force, this invisible, just movement force, magnet pulling the markets in one direction is basically telling you that it's more acting in favor of Bitcoin than it is in favor of Ethereum. All right. So all things concerned, if we are to measure, how risky the things are, well, we can always go and, like I said, and ask, for instance, those seasonal aspects, because it gives us a little bit of understanding. Okay, the volatility expected on the bottom right clip is 80.69%, right, throughout December. 80.69% throughout December. If we take it, for instance, through the standard deviation of Bitcoin, right, then there you go. Just gonna share it here. The annualized volatility of Bitcoin as of now is 56%, right? We are on the gain of 130% so far year to date, and 160%, 168% or so against 1 year, same time last year, right? So it gives you basically positive risk to return ratio, or actually return to risk ratio. So risk adjusted returns are positive, and they are much more positive than, for instance, on the S&P 500 side. So all in all, with the market cap of crypto basically going close to 3.5 trillion, with the Bitcoin dominance just falling off the cliff slightly lately, from 57, 58% down to 55, 56%, with Bitcoin price going higher and higher. This is a simple comparison, like I said, between the price performance of Bitcoin in the last 30 days and the DeFi index and the Ethereum in the green and the DeFi index. So DeFi is performing a little bit better overall than Ethereum. Bitcoin is on top of it. So still Bitcoin is the king, right? And if Bitcoin is the king, well, that's where that's where the focus goes. And if that's where the focus goes, it also empowers the rallies. One simple way to understand and appreciate the formulas for calculating the risk is basically utilizing this annual, annualized standard deviation. That's one thing that, like I said, is close to mid 50%, but also ATR, the average true range. And the average true range is basically if you have movements within a certain period of time, so certain time is, imagine 14 days, last 2 weeks, and that the biggest discrepancy between the lows and the highs is basically giving you a concept and understanding of what the risk is, right? This is the wildest, the biggest volatility. And if that is the case, it basically helps you calculate and understand, okay, this is what I've experienced in the last 14 days. So it's safe to set the higher risk bench, as a benchmark rather than the lower risk, because you want to be ready for the worst case scenario while appreciating the good case scenario. All right. So this way, this is exactly the wildest point, the wildest spread vertically between the low and the high in different configurations of the candlesticks. You can tell that this is exactly this result. So 32, almost 3,300 is a daily change on the ATRs. This is how big is going to be the candle, right? Imagine this is going to be like a doji, and this is going to be the high, this is going to be the low, and it gives us exactly 3,300, 3,300, Jesus, size, right? So this is the average kind of like a expectation for what market gives you right now. And if the market is on the lower volatility side, just for instance, like here, so 1900, before the 100% increase over the last couple of weeks, this gives you the information that the regular risk is actually smaller, is twice as small as the current risk. Basically, it informs you that you can do things twice more safely, right? So placing capital, the same amount of capital, is going to be right now exposed to twice as much risk as it was 2 months ago, so as it was a couple of weeks ago. So you can measure and size your positions based on the volatility using ATR, right? And then of course you have the 50-day moving average out of the ATR telling you which direction for the volatility is, right? Because we saw that the average volatility, for instance, in March was $4,000, right? Right now the peak was $3,700. The average 50-day volatility is $2,500, right? So the conclusion is that we are way above the average volatility at 3,300. This basically tells us that we're, still kind of like just on a fast growing pace of the trend, because of the volatility is needed for the trend to grow. And if that is the case, there is a high chance of the continuity of the trend so far. The volatility is rising on average. All in all, transmitting the message and contributing to the understanding that that the market itself is inviting you to appreciate the volatility, to appreciate the risk. It's becoming more and more risky, right? It's becoming riskier over the time rather than less risky. And that's supposed to be the tendency, because those strong trends, those strong breakouts, they initiated the trend waves, the trend impulses, right? As the wave practitioners would call it. And those impulse motive waves would mean with acceleration in the direction of the dominant trend, which is to the upside, defined by the 200-day moving average, right? So there's a high chance for the market to go up. December, positive 8.5.6% positive over the last 14 years, even though risk is actually a little bit big, on that front. Now, I'd say that with slightly better odds than 50-50, we have a chance for the December to be positive. 4 years ago, there was end of the year rally. The Santa Claus effect often works. And there's a lot of self-fulfilling prophecy reasons for the market and for those patterns to maintain. So the current trends are pointing upwards, and those trends have just gotten injected with hundreds and billions of dollars, and they're getting that on a daily basis. Next year, in just a little bit of a month, the MiCA regulations are coming, mixed markets and crypto assets in all the European Union, basically meaning the potential flow of fresh capital on the institutional side and the retail side to those crypto businesses means the market is going to grow bigger. And the market is going to grow bigger, you got to have more space to allocate more money in a space, right? So next to 6 to 9 months should be a spectacular growth, everybody. And volatility is supposed to rise. So the risk is supposed to rise, which means that as we go higher, technically, to lose less, we should allocate less and less capital as we go, right? Because if we expose ourselves to the biggest chunk of capital put at risk, the value at risk, right? At the very peak, basically means the biggest chances of losing biggest chunk of money. We don't want to do it, right? We actually want to give ourselves a chance to size the positions based on the volatility, and if it's rising, the sizing of the positions should be lower. And I think there's so much to be said about this that of course hundreds of books. I highly encourage everybody to go ahead and check the official CMT Association details along those notes. Very interesting path and very interesting details and materials for a lot of traders. And with the free Trading Congress or Trading Congress 2024, if you will, the 6th edition of that is basically where you become better traders, where you become where you have access to all those software, to all those pro traders guiding you through all the trenches, basically on the meme coin side too, to learn, teaching you basically how to stop falling victim of all those rug pulls, of all those scams, of all those Ponzi, of all those false scamming influencers that are basically dumping you on you all the time and just rugging your coins. The space is filled with scammers, but they're at the end of a tunnel. And this end of a tunnel is actually aggregating all the best speakers, all the competent, trustworthy, reliable, experienced, profitable traders and people to guide you through the space, to guide you through the trenches. And that's exactly what's going to happen through the next editions of the Congress, through this edition of the Congress, through the next shows of the Congress, because with this grand opening, we are just getting started. And if we are just getting started, there's so much more to come. And I invite you, everybody, to go ahead and check the description to the video where you're watching that on YouTube, on Twitter, and X. Drop some comments, drop some questions, hit the notification bells on so that you actually stay notified, because there's going to be loads of incredibly value-filled contents. There's going to be portfolio managers, hedge funds, VCs, incredible projects, incredible traders, profitable traders that you know from the space, your favorite legends. And each and every single one of them are going to come to give you the value for free. They're going to guide you about the best practicals and the best practices, the best practical methods on how to stay afloat, how to stay positive in this market, how to survive this incredible rallies, make shitloads of money safely, and at the same time not get wrecked and ruined after the bear market kicks in. And that's supposed to be 2026. So before that, there's a lot of lesson on how to stay profitable. And I invite you to the next sessions, everybody. That is happening just a couple of minutes with the incredible guests coming up soon after. And it's been a true pleasure hosting you for the grand opening of Congress, Trading Congress 2024, where you can learn how to become a better trader, because the best time is now. And if the best time is now, you might want to lock in, you might want to stay tuned for the next sessions, because they're coming right in a moment. And I've been your host, Adrian Zdunczyk, CMT, Charter Market Ignition. Welcome to the Trading Congress 2024, and I see you on the next sessions. God bless.